A sale and leaseback is a transaction where the owner of an asset sells it and then immediately leases it back from the new owner for a set period of time. This allows the original owner to free up capital tied in the asset while still being able to continue using it. Now, let's say there is a property which is owned by the first owner who then sells it to a second willing buyer. The buyer or the second owner then pays the first owner in cash and completes the transaction and now owns that property. He then leases it back to the first owner for a preset amount of annual rent. So the second owner now becomes a landlord while the first owner becomes a tenant for this property. Now, how it works? A company sells an asset, let's say a building or an equipment, to an investor. Simultaneously, the company enters into a lease agreement with the investor to continue using the asset. For example, let's say there is an airline company. This airline company owns many airplanes, but it needs some free cash for its day to day operation. Then it finds a leasing company, which is basically an investor with cash and who is willing to buy airplanes. It sells this airplanes to this leasing company and then takes the plane back on lease. So the primary purpose behind this kind of transaction is to convert the asset's equity into cash, which could be required for other purpose, without losing access to it. That is to convert the asset's equity into cash without losing access to it. This can be useful for various reasons, such as funding business expansion for the primary company, or managing debt, or improving their cash flow. So there are three key elements in this transaction. First, there is a seller or lessee, the original owner who sells the assets and then leases it back. Then there is a buyer or lessor, the investor who purchases that asset and then leases it back to the original owner or the seller. And the third is the leaseback agreement. It is the agreement where the seller continues to use the asset for a specified period of time. Now, there are some accounting considerations to be taken into account here. The transaction is analyzed by the income tax department or the audit committee to determine if the initial transfer qualifies as a sale with revenue recognition, which determines if the control of the asset has been passed to the buyer or not. And then if it has, then it is a sale and the seller de-recognizes the assets on their own balance sheet, and both parties, that is lessee and the lessor, apply the relevant accounting models for leases. Now let me leave you with a question here. Let's say there's an IT firm which owns a commercial building. Now they sell the building to an investment firm but immediately leases it back for 20 years. The company receives cash from the sale and can continue operating in the building while the investment firm owns the building now and receives the annual payment every year. Now, is this an example of a lease agreement or a rental agreement? If you know the right answer for this, please let me know in the comments. And until next time, see ya.